Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Multi-line insurance companies are insurers that write both life and non-life business under a single holding company. This structure, common in Africa, allows insurers to diversify across product lines, customer segments, and risk types, while sharing distribution, brand, and back-office infrastructure. Sanlam, Old Mutual, Momentum Metropolitan, and Britam are the leading multi-line insurers in Africa. This presentation examines the multi-line insurance landscape, focusing on the strategic advantages and challenges of the multi-line model and the multi-billion-dollar institutions that anchor this subsegment. The leading African multi-line insurers combine life and non-life business under one holding. Sanlam leads with a $10 billion United States dollar market capitalization and a 70-30 life to non-life premium mix. Old Mutual follows at $7 billion with a 75-25 split. Momentum Metropolitan, formed by the 2010 merger of Momentum and Metropolitan, has a $2 billion market cap. Britam Holdings of Kenya, Wafa Insurance of Morocco, Liberty Holdings of South Africa, Saham Finances of Morocco, and GA Insurance of Kenya round out the multi-line leaders. The life to non-life mix varies significantly, reflecting different strategic emphases and market positions. The strategic logic for multi-line insurance rests on three pillars. First, diversification. Combining life and non-life business produces more stable earnings than either segment alone, as the two businesses have different claim cycles, investment exposures, and economic sensitivities. Second, distribution leverage. A multi-line insurer can offer a complete product menu to its distribution force, increasing agent productivity and customer retention. Third, capital efficiency. Shared back-office infrastructure, brand investment, and reinsurance arrangements reduce unit costs. The trade-off is operational complexity, with the need to manage two distinct businesses with different cultures, risk profiles, and regulatory requirements. Successful multi-line insurers like Sanlam have invested heavily in shared services and unified brand architecture to maximize the synergies. Multi-line insurance offers 5 advantages. Earnings diversification. Life and non-life earnings are imperfectly correlated, smoothing total earnings through economic cycles. Cross-sell opportunities. Multi-line insurers can cross-sell life products to non-life customers and vice versa, lifting customer lifetime value. Shared distribution. A single distribution force can sell both life and non-life products, improving agent productivity and reducing distribution costs per policy. Shared infrastructure. Back-office, IT, finance, and corporate functions can be shared across the life and non-life businesses, reducing unit costs. And reinsurance buying power. Multi-line insurers can negotiate better reinsurance terms by aggregating treaty business across lines, reducing reinsurance cost. Multi-line and specialist insurance models offer different advantages. Multi-line insurers like Sanlam, Old Mutual, and Momentum Metropolitan operate across life, non-life, and increasingly asset management and wealth. The model maximizes diversification and cross-sell, but requires significant management attention to balance competing demands. Returns are steady but rarely industry-leading in any single segment. Specialist insurers like Discovery in Health, Santam in Property and Casualty, and OUTsurance in Direct Personal Lines focus on a single line of business. The model allows deeper product expertise, sharper brand positioning, and often superior returns, but with less diversification and more earnings volatility. Both models have proven viable in African insurance, and the choice depends on management capability and market positioning. Sanlam, founded in 1918, has built the most diversified insurance franchise in Africa. With operations in more than 30 African countries and a market capitalization of approximately $10 billion United States dollars, Sanlam combines life insurance, non-life insurance through Santam, asset management through Sanlam Investment Management, and wealth management through Sanlam Private Wealth. The group recently acquired the African operations of Allianz, significantly expanding its Pan-African footprint. Sanlam's strategy emphasizes diversification across product, geography, and customer segment, With a disciplined approach to capital allocation and a long track record of value creation for shareholders. The Sanlam model is the template for multi-line insurance success in Africa. Old Mutual, founded in 1845, has undergone significant restructuring over the past decade to simplify its structure and focus on African financial services. The group has divested its U.S. asset management business, separated its UK wealth operations, and listed its Zimbabwean operations separately. The remaining Old Mutual Limited focuses on South African life insurance, East African banking and insurance, and selected African operations. The restructuring has been challenging, with management turnover and strategic uncertainty weighing on the share price. However, the simplified structure, combined with Old Mutual's strong brand and extensive distribution, positions the group for a turnaround as African financial services continue to grow. In the 2023 financial year, leading multi-line insurers delivered an average return on equity of 11.8%, with Sanlam leading at approximately 14%. Combined premium across the top 5 multi-line insurers exceeded $25 billion United States dollars. Active customers exceeded 75 million across Africa, with Sanlam alone serving more than 30 million. Geographic reach extends to more than 30 African markets, with Sanlam the most diversified. The multi-line model has delivered steady, if unspectacular, returns, with the diversification benefit most evident during periods of stress in individual markets or product lines. 5 strategic imperatives apply to multi-line insurers. First, invest in digital distribution. Multi-line insurers must invest in digital distribution to compete with both digital native insurers and direct-to-consumer competitors. Second, simplify group structures. Complex group structures can be opaque and create holding company discounts, and simplification, including spin-offs of non-core units, can unlock value. Third, develop specialty expertise. Multi-line insurers must develop specialty expertise in growth categories like health, agricultural, and cyber insurance to compete with focused specialists. Fourth, pursue Pan-African consolidation. Acquisition of subscale insurers in fragmented markets can build regional scale and unlock cost synergies. Fifth, strengthen reinsurance frameworks. Sophisticated reinsurance frameworks, including captives and alternative risk transfer, can improve capital efficiency and earnings stability. In summary, multi-line insurers will continue to play a central role in African insurance, particularly through Pan-African consolidation. Digital distribution investment will be the primary competitive differentiator, allowing multi-line insurers to leverage their product breadth. Group simplification, including spin-offs and divestitures, will narrow holding company discounts and unlock shareholder value. And specialty expertise in health, agricultural, and cyber insurance will increasingly differentiate leading multi-line insurers from generalist peers. The multi-line insurance model, exemplified by Sanlam, remains the most powerful platform for Pan-African insurance growth. Thank you for watching this examination of multi-line insurance.